I've started the recording. All right, so here we'll continue with where we left off yesterday. So, far away. Right, so we are on the topic of eyeball, and we have covered two definitions, two understandings. Level 1, level 2, we've covered level 2 yesterday. We also did intrinsic versus time value. Now, there's a third answer here. There's a third way to understand intrinsic, third way to understand implied vol. That answer we will actually, that I'm calling it the intuitive answer number 2. Okay, first is the intuitive answer number 1. One is the intuitive answer number 1. The second is a mechanical answer. And the third is a intuitive answer number 2. This is the intuitive understanding of eye volatility. So this is that, this is basically what it is. This is the essence of this, okay? Now this, I'm not going to cover in great detail now, just because we are discussing the different understandings of eye vol, which is one of the most important concepts in option trading. So I'm just listing it out here and and just discussing it very briefly. But you would not understand what this really means until you understand how to calculate historical vol. Okay, so there is a book chapter which you can start reading already, which has that I've given the reference later. But there is a part where there's a calculation of historical volatility. So we'll do that later. And so once you do that, you'll have a better understanding of it. But essentially what it is this, if we go and open our eye volatility page, I think this is the, yeah. So if you look at this, there are in this eye vol chart here, they've actually, in vol chart, in this vol chart, they have actually plotted two types of vol. If you see here, the blue line is HV, and this is the orange line is IV. So the IV is the implied vol, which is derived from the current prices of options. And the H vol is actually derived from the asset price chart, from the movement of the asset price. So this is essentially like a standard deviation of price changes. So you do see that there is some correlation between the two, but they are not the same. So there are two things to note here. They're not completely out of line with each other, but they are also not, always in lockstep. So if you think that this is always going to be in lockstep, that's not going to happen. So, so essentially, what this what this eyeball is also the market's understanding of what this blue line figure will be 30 days. In the case, if you're calculating 30-year eyeball, 30-day eyeball, okay. So, for instance, 30-day option. If you take a 30-day option and you look at the eyeball of that is this, then the option market thinks that if you take a H vol reading 30 days from now, okay, using 30 days of previous data, that reading is going to be 42.4%. So this detail you'll understand a little better later when you do the calculation of H vol. But this is to understand, just to be comprehensive in at least mentioning the different concepts. The third level of understanding of eye vol is that it is the option market's view on the future readings of H vol. So essentially what these blue H vol readings will be, X days down the line, where X is the tenor of the option. In this case, it's 30 days. It could be any time period. So this is basically what it is. So there are different ways of understanding eye vol. We will understand this a little bit better later on once we do the reading of H vol. But I wanted to just mention that these two are actually connected. So you have to understand these two together. So eye vol and H vol are connected. And yeah, okay. So that's a brief mention of that. I just wanted to list it out with the other points. Okay, so we go on to our next subtopic, which is the gamma theta trade-off. This you have to understand, this particular terminology. Okay, this is again a market terminology. So as we say, it's a term of art which is used in the industry, which has a specific meaning, which you should understand what this is. Okay, so so essentially here what we'll do is, I'm mentioning this. This was a very important topic in option trading, but this is actually has direct P&L impact only for market makers. Okay, not, and you're not going to be behaving as a market maker in this project, and we will not have time to train you to trade like market makers in this particular course or in this set of electives, because we don't have the time. So we will be training you in the second category, okay, as a price taker. So we will be training you as a price taker. So you have to understand, I think we have discussed this briefly in the past, that there are two ways to trade options. One is as a market maker, one is as a directional speculator. Okay, so as a directional speculator. So both are speculative approaches to option trading. So if you remember a couple of days ago, Siddharth asked a question about options are used only for hedging, and he had read that somewhere or in many places. And as I told him, that statement is not correct. Okay, that's why one of the reasons why I say don't just read anything anywhere. Only read the material that I certify for you as good material. Okay, so because they don't know, I mean, a lot of time people make statements which are not strictly correct. They don't know how to write or talk about these important concepts. So both are speculative, approaches to option trading, which we are going to teach you. But you can also use options for hedging. But for the options, when you're using options for hedging, your training as a speculator is sufficient to be able to use the options for hedging. Okay, so that's why we don't have to train you separately for hedging. We will give you some ideas about hedging, some conceptual framework for hedging. That is sufficient. So we are going to be training you as price takers, but because the gamma theta trade-off is very important as a concept, so you should have an understanding about it. This is Avast trying to market its software. Okay. So gamma theta trade-off is direct. Yeah. So you are going to be you're going to be trading as price takers, but I'm just mentioning this gamma theta trade-off briefly, although it has been impact only for market makers, but this is a very important concept. Okay. So that, as I said, this is what is commonly discussed in markets, the gamma theta trade-off, and I'll come to this low part. I'll explain just briefly what this gamma theta trade-off is, so that you understand what we are talking about. If we go here to the option price calculator. All right. Now, notice one thing. Now, these prices, these obviously prices are for both buying and selling. But these Greeks that you see here, by this time you should be familiar with this term, the Greeks. These are called the Greeks, or the option sensitivities. Now, these are for long positions. Okay, these are given for long positions in these options. Okay, these two options. If you have because you can have a long position or a short position. So these are given for the long position holder. Okay, so there'll be some background noise right now, so just ignore it. Now, so these are for the long position holder, and that's why you notice that the theta is negative. You'll obviously see the Greeks also being shown in your TWS option trader. They show you the Greeks of the different options. Now, that's why the theta of both the options is negative. So if you buy whether you buy a put or a call, it is always true that if everything else ceteris paribus, everything else remaining the same, it is always going to be true if you're holding an option and the price, you bought a call option for 3.02 or a put option for, let's take the rounding down to 2. Okay. And we change from 30 days. Anyway, the 3.22, if you look at the call option price, is 3.02 for 30 days. And if we keep ceteris paribus, if we keep everything else the same, and we change it from 30 days to say 10 days or even 29 days, if you even change it to 29 days, see what happens to the option. You see, the value has dropped from 3.02 to 2.97. We didn't change anything except for the days until expiration, 1 day. So just in 1 day, if you had bought this option yesterday at 3.02, today, if nothing else changes, your option is today worth 2.97. You already lost money because you were long the option. On the other side, the guy who sold you the option has made money. So these Greeks are given for the long position side. That's why the theta is negative for both calls and puts. You would have noticed I didn't see the put price, but the put price would have also gone down. When we moved from 30 days to 29 days, the put price would have also gone down. That's why the theta of both of these is negative. So theta is just the partial derivative, okay? Or if you want to just understand it in terms of without involving the calculus part of it, it's just the sensitivity analysis. So it is the sensitivity of the call and put option premium to a change in this model input, days until expiration. So the point here is that if you have a long option position, whether it's a call or a put, then you have negative theta. This we have discussed before in our notes, right? We have, if you see somewhere and before this, we have talked about this. Yeah, here we have talked about it. A short option position has positive theta. That means it benefits from the passage of time. And a long option position has negative theta. Okay, so this positive, it's not very, it doesn't look very pretty here, but the positive then stroke negative. So short stroke long. Short is positive theta, long is negative theta. So the point here is that if you have a long option position, what I just showed you, you will lose value from the passage of time. All right. So everything obviously when we discuss in the case of options and many other areas is this term that you learned in economics, ceteris paribus, that is everything else remaining the same. So when you do sensitivity analysis, usually you do not vary more than one variable at a time. So what we're trying to say in the gamma theta trade-off is that, and you can see a sense of it from here, we can actually take, you can read a little bit over there, and you can leave it from, so we can take this whole thing here and repeat it a little bit when we are discussing the gamma theta trade-off. This is a very important aspect of option trading. If you have a very technical options interview, they may ask you about this. I don't know if they'll do, but I think it's always good. You must know this if you have understood, if you've studied option trading, it's an important thing to understand. Now, we will not put the Vega part of it right now here. Maybe what we'll do is we'll put it, add it to the, yeah, and the Vega theta trade-off, we will add it here. We will add this, both these two, and then we'll talk about it, okay? This we have discussed it later on, and we'll talk about it. So let's understand this gamma theta trade-off. So notice that as I already showed you, a long position in options has negative theta, short has positive theta. That means it benefits from the passage of time. But if you look at the other side, we'll delete this. We'll delete this for this discussion, this part of the discussion, because we're only interested in gamma and theta, right? So here, if you see, gamma actually has the opposite kind of characteristic to theta, okay? So while the holder of the long option, if you go back to the option price and look at the Greeks, as I told you, these Greeks are for long positions in the options. So the holder of the long option position, call or put, has negative theta. But what is the sign of the gamma? Can you see that? The gamma sign is positive for both, which means that long option positions, while they have negative theta, they have positive gamma. Okay, so this is what is meant. This is basically where the trade-off comes from. Okay, so what does positive gamma mean? Remember, gamma is referring to the. This is the only one which is not a, not a first derivative. It's actually a second derivative, which is the rate of change of the delta. It's trying to measure the rate of change of the delta as the underlying moves. So make sure you go back and study your Greeks very well. These are all basic aspects of option trading. So it's very important today, as I said once again, you have to be interested on your own in the subject matter. There is a tremendous amount, if you want to be a serious finance student, there's a tremendous amount of technical material to cover. And it is your responsibility to basically identify all the topics. I've done my best to identify topics like this. When we are doing this, this is the topic. So you make sure that you go by each subtopic and make sure that you have understood everything that I'm saying, everything that I'm writing. And it's your responsibility to, like some of you have complained about, not using a book, but using my notes, whatever. But it's the same thing for you. It's the same thing. It's what you're required to read. And so, as I've told you about my notes, if there's anything you don't understand, it's your responsibility to tell me that I'm not able to understand what you're saying here. And I haven't got that much of a response from anyone. On some people have come back saying that I didn't understand what you said here. That is what your duty is. Your duty is to read the stuff and make sure you understand it. If you don't understand it, then you ask me. I will rewrite the notes and I'll explain it to you. So you have to understand all this stuff. So the gamma here is positive gamma. So you have to be completely plugged into all this language, and you have to know exactly what these are. We have already covered it before. So gamma is talking about the rate of change of delta. It's like a kind of a very forward-looking measure. Okay, it's like at this point of time, the delta is of 0.53. That means it's telling you that if there's a for a change of 100% in the underlying price, the delta will change by 53%. Okay, so the delta itself is measuring the sensitivity of the option and put option and call option prices to a change in the underlying. So if this changes, if the underlying price changes by 100%, the call option delta will change. The price of the call option will change by 53%, and this will change by 47%, but in the opposite direction. So if this rises by 100%, then this will fall by, put option price will fall by 47%. That's what it means, okay? So delta is measuring the sensitivity of the option premium to a change in the underlying price, this model input, okay? If you change, as you have seen, if you change the underlying price, and once again, you should bring your intrinsic value and time value concepts into it, that because every option price consists of this price, it's got two parts to it. There is a intrinsic value part and a time value part. So whenever we are discussing a idea that says that the option price will change, you should also immediately test for yourself that as to whether the change is going to happen because of the intrinsic value component or the price or the time value component. Okay, that is for you, for your own understanding, to understand it better. So I'm just informing you here that when the delta changes, sorry, when we are discussing delta, we can't discuss gamma without discussing delta again. So when we are talking about delta, delta is talking about, it's trying to measure the change that will happen in these option premia as a result of changes in the underlying price. And so these changes are going to happen. I'm connecting this to the concept of intrinsic value. So when the when the call option premium change, put option premium and call option premium change as a result of changes in the underlying price, those changes are driven by changes in the intrinsic value. Okay, because the relationship, the strike is fixed. The relationship between the underlying and the strike, that is actually part of your concept of intrinsic value. So what the delta is measuring is the change in the option price that will happen as a result of changes in the intrinsic value, which are going to be driven by the movement of the underlying price. So that's delta. On the gamma side, what gamma is trying to measure is the rate of change of the delta. So it is a even more forward-looking measure than delta itself, the second derivative. That is how, for this option position, given the parameters, how fast is the delta likely to change once you have a first order change in the underlying price. Okay, so it's just like a forward-looking measure to measure the rate of change of delta. And this gamma, you'll notice, is positive for both calls and puts, long positions. So what the gamma theta, so that's why we have said here that a short option position has short gamma, long option has long gamma. What does that mean? In intuitive terms, okay, we are not going to get into the mathematical terms because it's not necessary to complicate it like that. What essentially this means is, if we go back to our if you also look at it this way, when the historical volatility is very high, okay, this is calculated using standard deviation of price changes, but broadly you can look at it as a chart which is going up and down, where there's a lot of dramatic movement in the price. When there's a lot, I'm just talking in terms of in loose, imprecise terms, using the way that human beings normally talk, that subjective words, like lot of up and down movement in the price. So when that happens, this measure is likely to go up. The historical volatility measure is likely to go up when that happens. So if you look at, so what I would say, for instance, is if we go back to one of our favorite charts, where we can show a lot of CL won't come here. We'll have to put, when you're using different types of software, you will get confused because sometimes you'll use a ticker. CL is the ticker for when you're calling up the futures contract. So if we go for all data here, okay, so broadly what I'm trying to illustrate is that if you did the historical vol calculations, you will see that at this, in this period, I've shown you this chart. I think I've shown it to you before. If you notice, essentially from the beginning of this chart, okay, till around this time, around 2002, etc., the movement in the oil price was quite limited. Okay, it was quite limited. It was moving in a very narrow range. And then you suddenly notice that after this, the prices start going up, and then there's a big drop. And you see that if you look at this second part, kind of broadly, this is the first half of the chart and the second half of the chart. They look very different because the regime has changed. Okay, so the regime has changed. So regime is a way of talking about, what is, the kind of philosophy that is in place. So you can talk about a change from the Congress regime to the BJP regime. This is how we use the word regime, but we can also use it in terms of time series data. You see, this is what we call a regime change. You look at this chart, same market, same instrument, but how dramatically different the left side looks, how dramatically different the left side looks relative to the right side of the second half of the chart. So this dramatic change, so here what we would say is the historical volatility is, let's try to find, let's see, plot this and see if we can search for it. Yeah, so let's look at historical volatility. I think they don't, maybe we'll set that. We won't worry about the time frame here, okay? So you will see essentially here, there's we have to modify the setting, the parameter. So essentially what we mean is that when there is dramatic up and down movement in the price, this actually, maybe we should not use H-fall comparison here. I'm just going to mention it with respect to the chart. So what this positive gamma means, in this context is that if you're holding a long option, you have positive gamma, and if there is going to be lots of dramatic movement in the price like it is happening here as compared to here, then that is going to benefit the market maker who's holding long options, because he will have positive gamma. So this relates to how the hedging is done for options by market. I mean, the how market makers trade options. So we're not going to go into that detail right now. But essentially, what this means, long gamma means if there is dramatic movement in the price, okay, as compared to here, for instance, here the long gamma position is going to make much more money for the person who's holding the long option position. Okay, that's what we mean. So long gamma essentially means this, that if there is dramatic movement in the price, you will benefit if you're holding a long option position. And if there isn't that much dramatic movement, there will not be so much benefit. Okay. And for those who are holding short option positions, because they will have short gamma, they will get badly hurt in this kind of a situation as compared to this. So that's basically how you should understand gamma at this point, in a very simple, intuitive kind of way. Okay. So we can write it this way, that I'm just going to use
So can you repeat the part of gamma again? The with the chart, it just went over my head. Sorry, sir.
No, I understand, because I also changed. I wanted to go by the historical volatility chart, and then I changed it back. It's perfectly fine. That's good that you have asked the question.
Sir, I also have one question.
Sorry, yes.
Sir, can you show that option value calculator?
Yeah.
Sir, in this you told that delta tells us that there will be a 53% change in the call option if there is the underlying price changes by 100%.
Yeah.
So delta is telling us that how our call option will be changed.
Yeah.
And gamma you told is like the second derivative, that how much delta will change.
Yeah.
So sir, how will we use it? What will be its practical implication when we are using the gamma? Delta, I understand that if the underlying price goes to 200, so the theoretical price will be 1.5 times roughly.
Yeah.
But what will be the gamma? What will be the implication of gamma in that?
So the implication of that, the question that you're asking is a very good question. Okay, it's a very relevant question. But to go into that question, this basically I would have to start this topic of how market makers trade options. When market makers are trading and are running an option book, okay, the guys with the prices that you see on the TWS, those prices, many of them are posted by market makers, and they will be managing their option portfolio or option book in a very different way to what you guys are going to be doing in your project. You're only going to be buying and selling options. So those guys will be not only buying and selling options, but also doing trades in the underlying asset. Okay. So the question is very relevant, but I'm not going to go into detail on it later, on it now, because that will not be part of what we'll cover in our syllabus. But essentially, I'll tell you what it means. I'll just briefly answer your question because it's important for everybody to have a sense of it. So what it means is that, how do you use it? Okay, if you're a market maker, what happens is if you have a long, so this requires an understanding of, how the actual market makers manage their portfolios. But what it will mean is essentially that if you have your option portfolio has high gamma, okay, high long gamma, then you will have to, essentially what you will do is you will place some orders, okay, in the underlying asset prices by anticipating dramatic changes in the price. Okay, so that's basically what it means in terms of that's obviously, I know it's not making much sense because I don't have time to go into the full detail of it, of this whole topic essentially. How market makers trade options. Okay, so you have to understand how they manage option portfolios. But essentially what it means is that, just to give you a short and superficial answer to your question, that in this case, if the guy has a long gamma position, or especially more important, if he has a short gamma position, because that way the risk is much more. Long gamma is just a question of capturing more profit. But what he will do is when he goes home, especially markets like foreign exchange, which are trading constantly, he will have a plan that if the underlying moves, suppose the prices are here right now, the underlying asset prices. But he will have a plan that if the underlying asset price moves down all the way this much to this price, he will have a plan as to what I'm going to do in terms of how many more units of the underlying asset do I have to buy or sell. So that's how the gamma is used, because gamma is a forward-looking measure. So if the underlying asset changes, how will the delta change as the underlying asset changes? So it's a second-order kind of measure. So this basically is helping the option trader to make a plan that, okay, this is here right now, but what do I do if this drops to here? Because what will happen is when this drops from here to here, there will be a change not only in my option price, but also in my option delta. And the reason these guys have to worry about the option delta is that when you're managing an option portfolio, you have risk limits, okay? So you'll have a risk limit for delta, you'll have a risk limit for this, all these, you'll have risk limits. And those will be in terms of millions of dollars, okay? It will be measured in US dollars. So based on how many $1 million worth of options you've sold, your delta will be measured as X $1 million, okay, etc. like that. So because the delta is going to change, if this underlying asset changes, not only will the underlying price change, will the option price change, but even the delta will change. And then the option trader is going to be asked by his risk manager, why is your delta busting the delta limit? So this guy has to remain within his limits for all these, Greeks. So because the delta is going to change, he knows not only will the option premium change if the underlying changes, but even the delta will change, and that's measured by the gamma. So to give you a short and superficial answer to that, because he also has to manage the delta positions, he has to stay within the limits. Make some plans to do some trades in the underlying asset. He will have to make some plans to do some trades in the underlying asset. To make sure that his delta does not increase as projected by the gamma. So these measures are based on the assumption that you don't do any trades in the underlying asset. So when you have the underlying asset has a 100 delta, okay? So in this situation, if you have, we have not discussed all that, whether the underlying asset has a 100 delta, because those discussions are part of this topic. How market makers trade options. We are not discussing that, but I'm just giving you an idea that an underlying, you can play back this part of the video later on if you want to understand it again. So the point is that these are all, Greek measures, assuming that there is no hedging of the option position in the underlying asset market. Okay, so you have the derivative market here, the derivative prices, and this is the underlying, asset price. So the way that market makers trade options is that they trade not just in the option prices, they buy and sell options, but they also buy and sell the underlying asset. They are rapidly buying and selling the underlying asset to hedge all these Greeks. So coming once again, because Utsav's question is a very good question, very important question. How will I make use of the gamma? This is what the market makers do. They look at the gamma, they anticipate how much the delta will change, and because the risk manager is going to come and question them, why are you busting your delta limits? So he will make some plans to hedge some of the Greek exposure by doing trades in the underlying asset, which will affect his delta exposure, okay? So for instance here, if you're talking about one.
Support on Spectre, Elite X2, X360, 103010. Dear customer, your time is important to us. To help us resolve the issue faster, it is recommended that you be with your product and have the...
Yeah, okay. So the point I was trying to mention is that if, for instance, let's understand a little bit about what delta means. Okay, so if you buy this option, if you buy this call option, you have a delta position of 0.53, okay? Now, what happens is if you buy 0.5, in this case, you're long delta, a put option has short delta. So if you buy this option and then you also sell 0.53 shares of stock, okay? So this is for one share, price is for one share. If you buy this option and then you also sell 0.53 shares of the same stock, Okay, assuming actually nowadays you have new software like Robinhood, which allows you to trade in fractional shares. So the concept of market lot is becoming a little bit obsolete, but I think we should still remember, because big, large institutional traders, uh, they will not usually trade in fractional prices. So I think the concept of market lots is still important, but it is important to understand that nowadays you can trade in fractional shares. So if you buy this option and also then later on very quickly sell, this is a positive delta. Now to offset the positive delta, you have to go short the underlying. Okay, so you have to understand that the underlying has 100 delta. So these concepts we have not discussed because we're not covering that topic. But the point is, bottom line is, if you buy this one option and you sell 0.3 shares of stock, okay, then your delta position will become zero, your net delta, because of the underlying asset has an opposite delta of the call option. So if you bought the call option and you saw the delta is 0.53 and you immediately sell 0.53 shares of stock, then your delta position will go to zero. Okay, so this is what is important to understand. So this is going back once again to Utsav's question, okay, which is very important. So what this guy is going to do is he's going to, suppose the market is sitting here, the underlying asset market, and the guy has a lot of option positions, and let's say he has a negative gamma. Okay, let's say he's short for the short option, he has a negative gamma, and so he knows that if the price drops from here to here, okay, the dramatic movement in the price, not only is his option price is going to change on the portfolio, but the delta will also change. So he should make some plans to buy the underlying asset, okay, as the to sell the underlying asset in his case, to do some trades in the underlying asset in general terms, if you want to talk in general terms. He's going to make some plans to do those trades, assuming those prices actually drop to these levels. So he will place limit orders. Okay, he will place limit orders for these for the underlying asset at different prices. Okay, so this is, hopefully it gives you some idea, Utsav, to what you were asking.
Yes, sir.
Obviously, I understand it's not going to be full clarity because we have not discussed many of the component concepts which we have to discuss to understand this whole topic. That's why I have planned not to cover it in your course, because it's a much more complex topic. But this is important to understand that this area exists, which we didn't have time to cover, and that's where the gamma theta trade-off is important. Okay, so I just wanted to cover that briefly, and yeah, so I'll come back now to Shaurya's question once again about this. That what this, if you look at the vol, dramatic vol difference, you can see that between the right side and the left side of the chart here. And so what this means is if you have a high gamma figure, if your portfolio has a high gamma, if there is a dramatic movement in the option in the underlying asset price, you will tend to make money. Okay, as an option trader, especially when you're managing it like a market maker, you will make money. This will be good for your portfolio. And if you have a short gamma position and this dramatic movement happens, you will lose money. So the gamma theta trade. So first of all, let me just understand, make sure that, Shaurya, is this making any sense to you? All that we are trying to say is, if you have a,
Yes, sir.
if you have a short gamma,
That high volatility, higher the volatility and higher we making money. That part I got.
yeah, if you're making money, if you're long gamma. So if you have this kind of dramatic movement and you're long gamma, then you'll be making money. But if you are short gamma, the opposite, you'll be losing money. So a guy who is short gamma does not want this kind of dramatic movement. He wants this kind of quiet activity. Let's just understand that visually. That is good enough. Okay. That then I'll explain it in your notes also. A guy who is short gamma does not want this kind of movement. He prefers to have this kind of movement, much more quiet. Market is not moving around much. Okay, that's basically the impact of the gamma on the option portfolio value. And the guy who is long gamma, he wants to have this kind of movement because he will have more opportunities to make money when this kind of dramatic movement happens. But if you buy options and you go long gamma and the price becomes quiet and goes to sleep like this, then there is not then you don't have opportunities to make money and you'll be losing money. Is this much clear? Sorry, this is clear.
Yes, sir.
So this is a little bit mechanical, but in a way, this is what it is. That if you have long gamma, you benefit. This is a part of the theory as well. So it's almost like memorizing it, but this is some of the basic. These are axiomatic truths. Okay, we can actually also give some logical derivation for these axioms, but for us now, we can take it as axiomatic. That if you have a long gamma option portfolio, then and you have dramatic movement in the underlying asset price, then that gives you many more opportunities to make money. So you are really happy when you have long gamma and you have this kind of movement, you're really happy. So conversely, if the long gamma guy is happy, the short gamma guy is not happy. So he is more happy when this happens. And then here the long gamma guy is not happy. Okay, so that's what it means. Long gamma means I want high volatility in the underlying asset price. I make money there. And short gamma means I don't want this, I want this. Okay. So this much is clear now, right? Okay. So yeah, I mean, so you already said it's clear now. So this is what we have to understand. So let me make sure I write this very clearly. Yeah, this is what I explained just now visually. I want to make sure that I write it here. I didn't write it earlier because I was not planning to cover this topic in great detail, but I thought it's as we went into the discussion. Okay, short long gamma positions. Let me write it in caps. Easier for me to see. So even though we are not going to cover the gamma theta trade-off in great detail, we're not covering how market makers actually trade options, the full detail. But we still should understand this much, that if you have a short gamma position, you stand to benefit when there is low volatility. If you have long gamma, you will benefit when there is high volatility in the, I'll put the dashes in here so you can break up the sentence, in the underlying asset price movement. Okay. Yeah. Okay. So this movement, this language is not very elegant here. High volatility in the let me put it this way: underlying asset price time series. That is a more technically correct way to put it. So this time series data of the underlying asset price, when you look at the time series data of the underlying asset price, here there is high volatility, here there is low volatility, and this means that the long gamma position benefits more from this than from this, whereas the short gamma benefits more from this than from this. So that's what it means. Okay, so but this is very important to understand. The short long gamma means high low volatility, the underlying asset price. Then short gamma will, in high volatility, short gamma will lose money, long gamma will make money, and vice versa. So this is an important point to understand. So we come back now to this idea of the theta Vega, the gamma theta trade-off. Why do we say there's a trade-off? Because now that you understand, theta is always negative for long option positions, and gamma is always positive, whether it's a put or a call. So what happens is when you buy, so the bottom line is this, okay? Because when you buy options, because theta is negative, so if nothing happens anywhere else, the underlying does not move, the vols don't move. Okay, these are the two main drivers of option premium. Okay, where there is uncertainty, because this one is always going to move in one direction, and you know every day this figure is going to go down by 1. There is no uncertainty here. Okay, we know that tomorrow it will be 28 days, day after it will be 27 days. So we have no uncertainty, although this is a variable. There is no uncertainty with respect to this variable because we know how it moves. Every day it changes by 1 and it only goes in one direction. So the real uncertainties are actually this one, underlying price, and the vol. These are the main drivers of option prices. And this affects the intrinsic value, and this affects the time value. This also affects the time value, but here there's no uncertainty. We know how it behaves. Here there is uncertainty. We don't know how this will turn out. This eyeball chart went up like this, but when we were standing here, nobody knew that this would happen. Then this would come down. So this is completely uncertain, like everything else in life. Okay. So therefore, this is where the uncertainty is. So when you have, so these are the two main drivers of option prices: movement in underlying prices, movement in vols. And when you have, when you buy an option, you have negative theta. So if this doesn't move and this doesn't move, you're dead, because your option is going to keep on losing value because this fellow is only moving in one direction and this fellow moves every day. This input is changing every day. It's always going in one direction. And if you're long options, it's always going against you. So you better get some dramatic moves here or here. Otherwise, you're dead. You're not making money. So this is basically the idea here in the gamma theta trade-off, that if you are long options, so you can see if you're long options, you have negative theta and positive gamma. So basically what you want, if you're, once you buy options, you want the market to behave like this. Remember, you can buy both puts and calls and you'll still benefit from this. So if you're buying options, if you're going long options, you want the market to start quickly behaving like this rather than like this. And that's where you have opportunities to make money, because every day, even when the market is moving like this, the theta is working against you. But at least the gamma will work in your favor if you have this kind of dramatic movement. Okay. So that's why we say that those who are holding long positions are set up to benefit from dramatic movement in in the underlying asset price and also in the eyeballs. Okay, even in the eyeballs, when you have see dramatic movement in the eyeball charts. Okay, even going up or going down. Okay, there's dramatic movement, and here you see eyeball is kind of not moving around much. This part, the orange line. So there are changes in the behavior of the eyeball chart also when you look at the time series. So essentially what we are saying is that if you have a long position, you have negative theta every day, your option position is losing value. But if you have positive gamma, so if the market moves dramatically, you will make money, right? So that's why the trade-off. If you feel that the market is going to move dramatically, you will go long options, okay? Because you want to have positive gamma. But the trade-off is that, yes, you're set up to benefit if this happens. If this happens, you're ready to benefit because you have gone long options. But if this doesn't happen and this happens, then you're actually going to be stuck because you're losing money every day due to theta. And because here the gamma will not benefit you much because the movement is not dramatic. So you're not even making money. So it's like, you know, if you think that house prices are going to go up a lot, you take a very high interest loan and you buy a lot of you take high interest loans, you buy a lot of houses, ready to speculate on the movement in the house prices. But house prices do not move up for many, many years. But you still have to pay interest on your loans. So you're getting killed by the interest, which is like the theta here, and your house prices are not going up. So you're not making money on the underlying asset. So therefore, it's the same kind. That's what we call a trade-off. Okay, so there is a trade-off, but here we are not talking about underlying asset position, we're talking about option positions. You buy options, every day they're losing money. If you don't have this kind of movement, you're going to get killed. That's what it means. Okay, so this is a very short understanding of the superficial understanding, but I think now you understand what I mean by the trade-off. Okay. Any questions at this stage about the trade-off, the gamma theta trade-off at a very superficial level? We have tried to understand it. No. So today we may not have our quiz session, okay, just to save a little time, but we'll have it quite frequently in this course. We'll try to have that. So this is basically what it is, okay? So gamma theta trade-off. And once you understand this, it's a little easier to understand the Vega theta trade-off also, which we will talk about a little bit more, which is relevant for your trading, what you're going to be doing, okay? This is DS is for directional speculator, which are, these people are different from market makers, and both of them are speculators. Both are speculators. If you go back to players in financial markets, directional speculators and market makers make up the category of speculators. Then you have hedgers, and you have arbitragers, and also you have certain government players who behave in very almost irrational ways. So, so this is what it is. Here's the trade-off. All right. Now, for those who are price takers, we are not really concerned with the gamma theta trade-off because we don't make trades in the underlying asset. Okay. So we are concerned with the Vega theta trade-off. And what you have to understand that when I use this term Vega theta trade-off, which I'm teaching you because you're doing this particular project, and I'm not letting you trade in the underlying asset. Now, you have to remember this, that the gamma theta trade-off is what is commonly discussed in markets in the industry, okay? So if you go to the industry and talk about the Vega theta trade-off, that is not something that people normally discuss, so they may not understand what they're talking about. But they will understand, but you may have to explain it. Sorry. Because what is more commonly discussed is the gamma theta trade-off. Okay. But I'll explain this. This is also important to understand, and you'll be facing it when you do your option trading. The same kind of thing, once you have understood gamma theta, Vega theta is a little bit easier to understand. And let's look at it briefly here. Notice that theta, this you already know, option position, long option positions have negative theta, both sides, both call and put. And also notice that long option positions have positive Vega, both call and put. And the Vega is the same for both, okay? So the same logic, it's now very easy to understand Vega theta trade-off once you have understood gamma theta trade-off, okay? Gamma theta is long options is long gamma, short theta. So if time passes and this one doesn't, the underlying doesn't move much, you lose money. So similarly here, long option positions have long Vega and short theta. So if you buy options, one thing that is clear is that the theta will continuously make you lose money, and nothing you can do about it. Every day the theta is going to cut down the value of your option price position, okay, every day that passes. But your Vega is positive, okay? And what does Vega measure? Vega measures the rate of change of the option price, sensitivity of the option price to a unit change in the vol. Okay, so if the vol, as you know, that this vol input, if it goes up, okay, and in this case, if you're talking about market prices, comparing it to the option OBM, then if the I vol goes up, okay, then the option price will go up, okay. So because the I vol is what they will insert here, and then the OBM will give you the same model output as the market price. So as the I vol goes up, this option price will go up. That's what the Vega is trying to measure. How much will the option price change if I do a 1 unit change, a 1% change in the vol input, in the OVM, okay? So the bottom line is here for us now to understand that long option positions have long Vega. So when you buy options, what you want is this. You want the I vol to start when you buy, let's say ideally you buy options here. If you buy options here when the I vol is 20% and then it shoots up to 80%, your option has automatically made a lot of money. As you can see here, if we keep nothing else, we can focus on both 297, 265, and we change the vol dramatically from 25 to 75. See what happens to the, nothing else is changing. See what happens? 297, 265, it goes to 8.5 to 8.24. This is one of the reasons why people can make a lot of money in option trading in terms of percentage returns, return on invested capital. If you calculate, you might have seen this if you do some reading and options here. Even in the textbook, you'll see this. Even in your textbook, there's a discussion of how you look at return on invested capital. And you'll see that the returns are very high, okay? Because your invested capital was 2.96, because the price of the option is 2.96. So your invested capital is 2.96, and you made a profit equal to about about 5.5. So imagine you made a return of 5.5 on an investment of 2.96. Okay, so it's almost a 200% return. And this is happening. You can see that in the case of Oracle, this happened basically in 1 month, Feb, March, 1.5 months. So it's in about 45 days, you're able to make a 200% return on your invested capital. So this kind of thinking you'll see mentioned in many places in option books, even in your textbook. But of course, what I've taught you in IPM, you should remember that what is more important than the return on invested capital is the return on risk capital. That is what really matters. Invested capital, I mean, that we have not discussed in great detail, but you should remember that what I'm just telling you, that don't get swayed by the return on invested capital. What really matters is the return on risk capital. That is what you have to look at. So we'll discuss that in great detail later on. But you should remember that term, that point, okay? That I'm just mentioning it here. I mean, maybe I'll mention it in the note here just to make sure that this is an important point. So I just mentioned this out of the blue actually in our discussion of okay, option trading textbooks. Okay, your own textbook has done it also. In your textbook, you'll find, wow, let's look at this, where we get a great return on invested capital. But option trading texts often discuss chances to make high returns on. So this is what happens, that this is what when some people have talked about, why aren't we using a textbook? Now this kind of input you will not get in a textbook, because the textbook doesn't focus so much on distinction between people usually talk about return on invested capital, but actually what really matters is the return on risk capital. Okay, so these kinds of insights you will not get if I don't bring my own experience into the picture and modify your curriculum by introducing ideas which are relevant from a real life perspective. Make high returns on invested capital. Okay. Due to low investment in option purchases. Okay, so I just showed you an example where you make almost a 200% return in 45 days. Why is that happening? Because look at it this way. The 200% return is because the option price was only 297. Now see the difference between the call option price and the underlying asset price. A call option gives you the right to buy 1 share, and for that you're paying $3. And what is the price of the underlying asset? It's $100. So if you wanted to buy 1 share, you would have had to pay $100. But instead of paying $100, you can buy 1 call option, which gives you the right to buy 1 share at $3. So see the difference between $3 and $100. So the reason you get a high ROIC calculation, okay, because you are making around 5.5 profit, absolute profit on an investment of 3 roughly. Okay, so almost 200% return under 3, investment of under 3. The reason you're getting it because the price of the call option is $3, whereas the price of the underlying asset is $100. So this is what is driving the high ROIC calculation. Okay, so this is what I'm writing about here. That so this is one of the topics that we are discussing. Okay, and why is there low investment in option prices? Why is there high return on invested capital? Because there is low investment in option purchases. So the denominator is low. That's why the ratio is high. And it's low. When I say low, yes, low relative to purchases of the underlying asset. That I showed you, the underlying asset price is 100. Option price is $3. So obviously there's a low investment here. And because the denominator is low, the return on invested capital is low. But the point the message I want you to take home is that but the true indicator to focus on, or let's put it this way, not the true. By now, you already have been taught the difference between invested capital and risk capital. Okay, but returns on risk capital. Okay, because for many reasons actually, but returns on risk capital, which is we can call it RORC, which is well, there are because what is the as some people like to say, what is the because? That of course you don't use English like that. Don't say what is the because. I'm just joking here. So because you can have two causes. You can have one is that risk cap drives position size. Remember how we derive position sizes? And position size drives profit making capacity. Okay, position size drives or determines, you can say. Risk cap determines would be a better word. So let's say risk cap determines position size, and position size determines profit potential. Okay, so obviously if the price moves by $1 to 101, if I'm buying one share, then I can only make $1 of profit. But if I have bought 10 million shares, then in one price change I can make $10 million. Okay, so because my position size is different. So this is what the position size does. So what I'm writing here is in today's session is that risk capital determines position size and position size determines the profit potential. Okay, so that is one of the reasons why RORC is the correct calculation, not ROIC. And the other reason, of course, is that ROIC, let's put it this way. Invested capital, I will show you this in a different session, okay? But that the invested capital can, if you see, we discussed various types of, if you see here at the very beginning, when we discuss this, we're talking about different types of instruments, okay? And you have already seen one example of this. Now we are discussing options. Okay, now this is a type of instrument. Spot is also a type of instrument. So you can see already what I'm going to mention now is what is the invested capital requirement if I want to trade in spot? If this underlying price is trading on a spot basis, if I want to trade in the spot market, my invested capital requirement is $100. Okay, it's $100. And if I wanted to trade in the derivative market here, in the option market, my invested capital requirement is, right now it's 8.5, but earlier I showed you 2.97, $3. It was $3. Now, this point is that this is different between two instruments, okay? And it can also differ based on where you're trading. If you're trading, for instance, you can take a position, equivalent position in spot versus futures, okay? Even in futures, which we have not covered yet, okay? We'll cover it in the next session, in the next course. But in futures, you will have a much smaller requirement to put up money. Your invested capital requirement will differ relative to spot. Okay, so the point I'm trying to emphasize here is that, so the point is that the invested capital requirements will differ depending on which instrument you're using, but the will differ according to the different instruments that you're using. So it will affect the ROIC calculation. But this is not the true, because if you can do it in different instruments and there are differences, this is not a real difference actually. I mean, in the sense that this would not be the true measure. But what is not changing across all these options is that your capacity to take risk. It's the risk capital that is constant in all these situations. So if you have a risk capital driven approach to risk management, as we have taught you to practice, which is that you determine the position size based on, so this approach, when you say that risk capital determines position size, so therefore your position size is being determined by risk capital, and so therefore your risk capital is the true measure that should be used across different instruments, because it's the same concept. My point I'm trying to make is that whether you're trading futures or you're trading spot or trading options, what is not changing is that if your investor has told you that you can't lose more than $10 million in a quarter, now that's not going to change whether you use options or you use spot or you use futures, okay? Because that guy can't afford to lose more than $10 million in a quarter. So the true way to measure the return on risk or the return on capital is to look at risk capital, because the risk capital is the one that does not change depending on which instrument you're using. But invested capital requirements change depending on which instrument you're using. As you have already seen, futures I have not taught you, so you have not seen that. But you can straight away see that here, if you want to trade in spot, you have to pay $100 per share. Here you have to pay $8.50 per share if you want to buy one call option, the right to buy one share. So you are able to control the same amount of position, okay? But your invested capital requirement is much less. So therefore, the invested capital requirements change across depending on the instrument, okay? But what does not change is the risk capital. If you have risk capital limits, the investor is not going to accept a loss greater than $10 million. You can trade in spot, you can trade in forwards and swaps and options, whatever you want to do, but just make sure you don't lose more than $10 million. So risk capital is the true measure, okay? Risk capital is the true measure that you have to focus on. So that is one, and risk capital determines position size, and invested capital requirements I think my spelling is not correct. Let them do it. Okay, so I think you'll get a flavor of what I'm saying here, that if you have a type of measure which does not vary across instruments, risk capital, I give you freedom to trade whatever you want, but just make sure you don't lose more than $10 million in a quarter. So, but if you trade this, you'll have lower invested capital requirements than if you trade this. Okay, it's the nature of the market. So therefore, this is the true measure, not invested capital. This is the one that is not changing across the instruments. Okay, so because of this, so the basic lesson I'm telling you, which you will not find in any textbook, is that do not get fooled by this. The correct indicator is focus. The correct indicator that you must always remember to focus on is return on risk capital. This mistake happens in the textbooks because generally people don't make the distinction between invested capital and risk capital, which is a very important distinction to understand. But because that gets missed out in traditional finance theory, that is not a focus, and therefore the this particular focus does not come. ROIC becomes the important focus. So you will find this discussion in your textbook also. Wow, look at options, see how they are giving you a great opportunity to make money. So that kind of thing you'll see in many textbooks, right? So I have to just keep an eye on the time because today I didn't set the time, the time requirement, the alarm clock. Okay, so all right, so what we are discussing here. So I hope everybody got what I discussed here in this module. This is an important discussion. We'll expand on this a little later. It came up in today's discussion, so I just mentioned it. That the bottom line message here is this, that do not get fooled when you see in many option books, return on risk capital, high return on risk capital opportunities in options. Sorry, not return on risk capital, return on ROIC, high ROIC, high returns on invested capital. But don't get fooled by it. Remember that the true measure is the return on risk capital, which really does not change in whether you're trading options or things, because you can't afford to lose more than a certain amount of money in any period. Okay, so never lose sight of this. So to go back to where we were actually. So today we have discussed a few unplanned concepts. Partly one is the deriving from Utsav's question on what is the way to use the gamma. But because, but it's an important thing to understand. So I just elaborated a little bit of this, that what is the meaning of short and long gamma in relation to how the underlying asset price is moving. Short gamma is going to get killed when you have this kind of movement. And long gamma is going to get killed when you have this kind of movement. So, and then you have the trade-off between the two, okay? So in the case of the Vega Theta trade-off, what we are saying is that it's the same thing, very easy to understand, that when you buy here, you saw this, we already mentioned this, that when you buy an option, ideally, you buy Oracle options, both calls and puts, okay? Because you're trading only in options. You don't know whether the underlying asset will go down or up, but you buy both calls and puts because you think the eyeball is going to shoot up, and the eyeball actually shoots up, okay, dramatically. So if you buy calls and puts, you have positive Vega, which means if the eyeball goes up, you'll make money. Okay, that's what positive Vega means. You already saw that. Call price went from $3 to $8.50. Okay, as the vol changed. Now, what I'm saying here is that, so obviously that's great, but what if this did not happen? What if you bought it and it just kind of stays there, doesn't move much? Maybe you bought it around here, so 30 eyeball was 30 when you bought it, and then it went up a little bit, then came down again, went up again, came down. So it's not really going anywhere. Okay, so you bought it here maybe in June, and then you're waiting and waiting in July, September. It's still around the same level. So there's not much movement in the vol, hardly any movement in the vol, net movement. And so your option is not benefiting, even though you have positive Vega because you're long options, but the eyeball is not moving. So your vol input here is not going to change. So the option price is not going to change. So because the eyeball is not moving, you have positive Vega obviously, but you're not able to benefit from the positive Vega because the eyeball is not changing. It's not moving around much. It is kind of hugging the same tight range. So that's not good for you, okay? Because the eyeball is not moving. Your long option position having positive Vega does not benefit you in any way because the eyeball is not moving. Unlike here, where you get a big benefit from positive Vega because the eyeball jumps dramatically, okay? Huge movement in option prices because they have positive Vega, the dramatic jump in eyeball pushes up the option prices. So the point is that here, if you come back to here, but here, no such benefit. Long period of time has passed, no movement in the option price. So, but remember the other side, the Vega Theta trade-off. Vega Theta trade-off, remember the other side that, okay, so the Vega has long, short, long Vega if you have a short, long option position. But you also have negative theta. So if you have a long option position, you have negative theta. So say you bought it in June and now it has come to, let's say, after September. So you have June, July, August, September. 4 months have passed. No movement in your option price due to changes in eyeball because Vega has not really moved much. But the time has passed. 4 months have gone by. So can you imagine the difference in the price? Okay, 4 months, if you bought a 6-month option, maybe initially if you buy, let's say you take any situation where you have, let's say if you have a 6-month option, 180 days initially, you look at the option price, it's 21.45. You keep the vol the same. It's 21.45. Now I changed from 180, 4 months have passed. So this what is left is only 60 because 30 into 4, 120 days have passed. Now what happens to the option price? Nothing else changes. 21.45 goes to 12.36. You see this? This is the negative theta impact. That after 4 months have passed, then the option price is almost dropped in half. Okay. So therefore, this is the negative theta eating away at your option price, option value of your option portfolio, long option portfolio. And unfortunately, the Vega did not help you because you bought thinking that the eyeball would go up, but it did not. So you got killed by the theta in the 4 months. The options dropped in value almost by 50%, but there was no benefit from the theta. So this is the trade-off. That by going long options, you are set up to benefit from high Vega. From dramatic movements, you're set up basically going long options means having positive Vega, which means you are set up to benefit from this kind of move. Dramatic rise in the option price. You're set up to benefit from this kind of move. But if this kind of move doesn't happen and this kind of move happens, the theta is going to kill you every day anyway. So therefore, long options, if you go long options thinking, wow, I'm going to make money from a dramatic change in the vol, well, you better be careful because you're going to have negative theta with long options. And if this movement does not happen and this happens, then you're going to get killed by the theta. So the long option has negative theta and positive Vega, and that's where the trade-off comes in. So every time you go long options, and the same logic applies on the short side. If you think that you're going to go short options here because you think the Vega is going to decline, well, it better actually decline like this, okay? Because if instead of declining, if it keeps going even further up, then you're going to get killed because of your short Vega. Although your theta will be positive, when you're short options, you'll make money every day from the passage of theta. But what you really want when you go short options is you don't want this underlying movement is of course going to affect the gamma and the delta and the gamma, but it will also have an effect on the eyeball. So you don't want this kind of dramatic movement in the eyeball if you're going short options. It will dramatically make you lose money on the option valuation, as you have seen. So if you go short options, you want the eyeball to rapidly decline and then you'll make money. Okay. And on the same, you'll have a double value benefit if you go short options because the theta will also be positive for you because you're short options, and the gamma will also be the Vega will also be giving you profits because you were able to guess the eyeball movement correctly. Okay, it went up. I mean, it came down, and that's what you projected. Okay, so this is what is meant by the Vega theta trade-off. You have to be careful about one thing. Okay. That Vega theta trade-off is not commonly discussed in industry. The reason I'm mentioning it for you guys is because this is what you are going to see in your trading project, because I'm not letting you trade underlying. So you will not be able to exploit the gamma of your portfolio. In order to do that, you have to be able to trade in the underlying asset. I'm not letting you do that. So you're, for instance, effectively stuck on this trade-off. You still have the trade-off. If you are going to be a buyer of options, you're going to have negative theta. So you're going to lose money every day. So you better get your guess on Vega and essentially delta and gamma. So you better get your movement of vol and the underlying price. You better get that right, the forecast of those moves. Okay, so this is what you have to do. So we'll discuss those that framework a little bit later, but that's essentially what it is. Okay, so if you have we have just 1 minute left, so we can actually, I think this we have already discussed in the Vega theta trade-off. Where we discussed. Yeah, this has already been discussed here. This part, this important point, that impact of one factor can more than offset the impact of the other factor, which I showed you. And this same point is repeated down here under the Vega theta trade-off. Okay, so I'm not going to discuss it once again. So we'll stop here. It's 12:45. Although we started a little bit late today with some because of some tech problems that I had. So we'll stop here, and if you have any questions, you can stay back. And if you first, we'll go with the technical questions. If anybody has, the rest of you, the class is dismissed, so the rest of you can go. Mithali, you can stay back what was I? Okay, I think what we'll do is I'll send Mithali. Have you sent me your? Okay, you guys are dismissed now. You can leave. I'll stop before I stop the recording and before I come to Mithali's question about the account problem. Does anybody have, the rest of the class can leave, the class is dismissed. And those who have questions, technical questions or conceptual questions or technical questions, or on the other hand, also administrative problems, those people can stay back. Yeah, sure, yeah. What is it?
Yes, sir. My question is that you said something about not able using the Vega and not able to exploit the underlying asset. What does that mean? So that it doesn't happen, or you said that we won't even be able to do it. So what was that part exactly?
Yeah,
at the end right now.
That what I'm saying essentially here is, as you understood in the answer that I gave, slightly superficial answer to Utsav's question about how to make use of the gamma. The way you make use of the gamma is by looking ahead, and if the underlying asset price is here, you look at your portfolio gamma and you try to imagine what the delta of your
basically a risk calculator kind of a thing.
Sorry?
It's kind of a risk estimator.
Correct. These are all risk measures. These are all option risk measures. Vega, theta, because they are essentially like I wanted to connect it to one of the concepts learned, a simple concept, sensitivity analysis. Okay. For every 1% change in the interest rate, your portfolio will change by say 2%. Okay, so it's a 200% sensitivity. So that's the kind of thinking. So it's a risk measure. You're absolutely correct. These are all risk measures. That's why when you have an option trader, when you are running an option portfolio, you have limits based on all these factors. You have delta limits, you have gamma limits, you have Vega limits, theta limits, everything. So the investor which is the bank or bank that you're trading for, they don't want you to lose money, more than some amount of money in every period. Okay, so that's your risk capital limitation, and so they cover your risk. They try to put constraints on you on your risk limits. Also, these are all risk measures that relate to option positions. So what I was telling you is that the way you make use of gamma is by projecting, okay, if the underlying asset drops here, my delta will be so much, okay? And therefore, to cover my delta, which is going to become so high, I had better buy some underlying asset at this price, or better sell some underlying asset at this price. So the way you manage your delta is by buying and selling the underlying asset, okay, because this I've not explained to you properly. But effectively, the underlying asset has 100 delta, whereas the call option has a 57% delta. Whereas this has you can say this has a 57 delta and this has a 43 delta negative, and the underlying asset has a 100 delta. Not because the price is 100, but the relative to these two, it's 100%. So what you can do is you can affect the delta of your, when you look at the total position delta, the portfolio option portfolio delta, you include the underlying asset hedge positions. Okay, we are not discussing this in detail because it covers the market maker option trading. We are not doing that. We are doing only directional speculator option trading in your portfolio, which is how I'm going to answer your question. But the point is that you will trade underlying assets, and you can, if you trade underlying assets, they have 100 delta. So that will offset the call option or put option delta, and then your total portfolio delta will be neutralized. So when the risk manager comes and says, hey, what happened, Shaurya? You bought an option, your delta is 0.57. You are busting the limit. Then Shaurya will point out to the risk manager, no, look at my underlying asset hedge portfolio. I have bought 0.57, I have sold 0.57 shares of stock. So I bought one call option, which gave me a delta of 0.57, but I sold 0.57 shares of the underlying asset, which will have a delta of minus 0.57 because I sold it. So minus 0.57 plus 0.57, net is 0. So then Shaurya will say, look, risk manager, my net delta position is 0. Now, this is how you do, this is partly how you do money, how you do the option trading as a market maker. Okay, you manage these risk measures as you correctly estimated. These are risk measures. You manage these risks by trading in various underlying assets, trading other options. It will affect your Vega. And so mainly by buying and selling options and by buying and selling the underlying asset. So now this, what I'm saying, coming back to your original question is, you will not be able to do this. You will not be able to see this. Why? Because I'm not letting you trade in underlying assets. In this particular project, I am, remember that which markets, which instruments you can trade is determined by the investor mandate. So I am your investor. My mandate is you can only trade in options. You cannot trade in underlying. So therefore, you cannot manage your gamma. So you do not have the gamma theta trade-off. I am letting you trade only in options. So you can manage your Vega. So what you can do is you can manage your Vega theta trade-off. If you buy options, you will be long Vega, but you will be short theta. If you sell options, you will have positive theta, but you will have negative Vega. So if you have sold options at this point and prices eyeball moves up this much, then you're dead because you are going to lose money. So that's basically it. So does that answer your question, Shaurya? That
the last part I did not get. It would go up, then it would be bad for me because that part, yes.
Here, because
yes, sir.
You go short options, you see, long option positions have positive Vega, which means if you flip,
okay. Because I want it more or less stable.
Sorry, come again.
Because I would want it the market to go in a stable manner if I am a short gamma dealer, right?
Yeah. Now don't say gamma here because we are now discussing Vega. Yeah,
Vega.
Statement is correct, but now we have moved the discussion to Vega. I thought you were asking about this, but you're right about both in the sense that if you are short, if you're a short option, if you have a short option position, then you're short gamma and you're short Vega. So what you want is two things. Because of your short gamma, you want the option mark, if you want the underlying asset price to behave like this and not like this. That's one. Okay. If you're short options, you have short gamma and short Vega. So because of your short gamma, you want the underlying asset to behave like this and not like this. That's one. Because of your short Vega, which is sensitivity to eyeball, you want the eyeball not to behave like this. You want it to behave either coming down or just not moving around much. You do not want this. You understand what I'm saying? because
Yes, sir.
you are short Vega. In a short Vega position, if the eyeball shoots up, you will lose money. So when you go short Vega, what you want is either the eyeball should dramatically fall, or it should just go up and down, not going anywhere. You understand now?
Yeah.
Sorry, your voice is cracking up. Your voice is not clear. Okay, we can follow up, and because I'm not able to hear Shaurya's audio properly, so that's we can discuss it again once again. You can listen to this. Yeah, so Shaurya has a message. Your chat. Yeah, okay, good. He has understood. So he's got the message that he understood. Okay. All right, guys. Okay, so anybody else or Shaurya has any other question, or anybody else has any other conceptual question? No? Okay. So then we'll just move on to Mitali's administrative problem. So you have you sent me those email addresses? Has Mitali sent me the email addresses? Let me check. At the beginning of the class, he had not yet sent it to me. No, there is no. I'm going to